Hello and welcome to KYC. I am Sharad Dubey and you are watching NDTV Profit. And let's start the show by introducing you to a company. But remember, I'll give you some hints to it and it'll be easy for you to guess because the company is very niche and it's one of the few players to be listed in this category. It's a medical device manufacturer. That's the first hint I'm giving you. The second hint is the stock is down 38% in the last 1 year itself, out of favor when it comes to the investor community and of course testing the patience also. The third important statement is that the exports has impacted the Q3 numbers also, especially the competition from America. So this is a beaten down sector stock. But let's talk about what this company is. It's of course a sectoral leader when it comes to the exports, and company works in the consumable devices. It's a technical term, but I'll simplify it for you. The company in focus is Poly Medicure. This is the company which we'll be talking about. Poly Med is the brand. You could talk about it, and there are certain questions which need to be asked. Of course, earnings season is definitely there, but this has been, you could say, a weak set of earnings coming in. There are key questions for these conversations to start with. The first one is, will the export weakness continue, especially in the European markets? The Chinese products are actually flooding and giving a big industry pressure in the PLM segment. What's the clarity with respect to the trade deal disputes, especially with US? Because the trade deal has happened, but for US medical devices, certain trade barriers might be removed. And if that happens, maybe for the domestic demand, some questions might arise. Low-tech products, the company has been dealing with that, with the majority of them in that portfolio. Now it wants to shift. That's what it's stated in the con call, but it takes time. And when that time comes in, that is where it's testing the patience of the investors. The China competition angle is very, very concerning, especially what the brokerages have written in their notes after the company came out with its numbers and the benefit from the FTIs and the union budget. It seems a bit generic for this company, but how much does it change? You remember US tariff is down from 50 to 18%, and importantly the acquisitions and the integration pipeline. Integration is already, the acquisitions have happened by when they'll get integrated into the company, and furthermore from the cash balance which I saw, are there any other acquisitions happening? And if yes, which geographies, which product categories, where margins will come in? All of these questions which we have made and crowdsourced from our viewers who watch KYC, this will be presented to Himanshu Baid. He's the MD of the company. Over the last 30 years, he has formed this company. But let's give in a little bit more details about the company because it's a very technical sector. At one time, the sector was a favorite amongst the retail, but then the derating happened. That's what my interest was, to get this company and the industry spokesperson to understand whether it has turned commoditized or is there some green shoots. So they are the manufacturer and export of medical devices. To simplify that, let's get into a deep aspect of it. 69% of this comes international. That is very much important because the Chinese are flooding the markets, and India also 31% is there. But question mark arising from US medical devices, will they be given more benefits than our domestic also industry might be impacted? The geographical segment, how the breakup happens, is very much important. The European is roughly 33% geographical revenue, and it's even Stevens. At times, these type of geographical breakups are very beneficial also in a business model. And you see, there is no major concentration, so that's a good point. But will this fructify into numbers? That's what we are waiting for. Segmental revenue, infusion therapy, that is 56%. Renal is 9%, others is 35%. So there is a significant dependence when it comes to the infusion therapy. But remember, the street is concerned. It's a low margin product. It's a core business, but a low margin product. And that is why the market is not giving the valuation to this company. I'll get to that point as well. And US-India trade deal is very much important. So I'll revise that with you. The price competitiveness in the US market, that's an important point. Apart from this, the duty cut, that's everybody very bullish on. But does that duty cut come into the company also? There is a different angle to it. That's why I'll explain you. And they make the Indian medtech more cost competitive versus the Chinese imports. That's the fight. That's the biggest question. That's why we are getting this company. And the USA is a key export market for the Indian medical devices. What are the US counterparts doing? That is something which we will be asking Himanshu ji. But moving on, the export expansion potential, that will be something which we'll be looking out for. And going ahead, if you look at the key other factors, this is the sustained tariff advantages, which makes India an attractive bet. So will they get in more capacity expansion? How are the inquiries coming from foreign? That's what we'll be looking out for. And remember, the investor confidence is boosted, but it's not coming in the stock prices yet, and it's bringing in more capital and R&D. That is something which you'll be watching out for. But there are big questions also. Is the medical device sector commoditized? That's the first question. Is the worst over for Poly Medicure? Second question. And the third question to ponder upon is exports. There is two portions to it. Is the FTA benefits versus the Chinese competition? Where does the story lie? I'll explain you much more now. I've given you the picture, but let's come here and understand the ratings, how we put a company in the KYC segment. Of course, numbers is something, it's the most important thing. It's the holy grail for analyzing any company. Income statement, balance sheet, cash flow, these are the basic parameters which we focus on. Then we understand return ratios as well. Apart from that, the shareholding, how much institutional movement has happened, and the street cred. Did the investors make money in this stock? The most important thing when you come into the stock market is you want profit. Does the company deliver? That's the simple question, but the most hardest one to answer for everyone. Valuations, the company doesn't have an actual direct peer because of the size. It's a larger player, so we will be comparing the history and the averages to see whether any value is left or not, or maybe is there a derating happening in the sector. And lastly, the outlook. Company specific, industry specific, and what lies ahead. Simple outlook, but it's very much important because the company might get derated more or re-rated. It's at an inflection point. A lot of negative news flows are coming in. So overall, these are the 8 rating parameters. The first one is the income statement. Let's look at the numbers. Numbers look decent, and these are the 3-year CAGR numbers I'm talking about, the revenue, the EBITDA. The movement is happening, is pretty much decent for a company growing at this size. Remember, it's a large player, and it's a good growth coming in. PAT is 32%, revenue and EBITDA. It looks good on the screen, but the stress starts when you see the quarterly numbers. Pull out the Q3 numbers, and that's where the concern lies. Sequentially, there has been a degrowth, and also year-on-year basis, and market is not looking at the revenue and EBITDA. The EBITDA is anyways in single digit. But the concern is here. Look at that. Both YOY and sequential basis, the weakness is continuing. Exports impact is there. Chinese competition is there. And the margin trajectory, something with a high margin of around 28-30%, which you expect, that has come down to 24%. And that is a key concern coming in. Is there a pricing pressure? What will be the margin outlook ahead? All these questions will be answered by Himanshu ji. But moving on, history has been good, present is shaky, so it's a neutral rating when it comes to the income statement. Let's pull out the balance sheet to give you another picture also. And largely, if you look at the balance sheet, it is still stable. The book value numbers, the borrowing numbers, even though the borrowing has gone up, remember, company is doing expansion as well. They're trying to get into the new product categories, and these are the short-term loans. So it's nothing to be concerned of. This is not long-term borrowings happening. So of course, company's scale of work is increasing, and that is why a little bit of pressure is definitely coming in. The cash bank balance is something which I talk about, 183 crores. Now, will the company deploy in further acquisition? Because they have already done that, and there was a fundraise also. That is why we'll see some aberrations in the return ratios. But net, it is still better capitalized, and cash balance utilization, we'll talk about it. So it's a neutral rating for the balance sheet. So we spoke about income statement, we spoke about balance sheet, but cash flows are very much important, irrespective of any business model we talk about. And largely this is neutral, and I'm just looking at the cash flow to PAT ratios. It's been decent. The PAT number has been going up, and cash flow from operation is something which is good, but there is a dip coming in FY25, and remember that dip has started coming in the 9-month numbers also, and that is where my concern lies. But overall, company's liquidity management is decent enough, and that is why I have given a benefit of doubt in my analysis to the company this time, and that's why it's a neutral rating for the cash flow segment. Now the concern starts coming in with so many fundraise adjustments, the expansion adjustments, somewhere your return ratios will get hit. So let's just pull out the return ratios where the concern lies, and that's what I was talking about. Generally, anything between 18 to 24% is something which is a good or expected return ratios coming in, and largely we thought it would be coming in at 23 odd percent, but then there's a decline coming in, and it's a big decline. Of course, there are some adjustments here, but the market always looks at the numbers and what's the future lying ahead. Let's look at the ROCE number also to see whether the picture is same or not, and it's likely going to be a mirror image. And yes, it is a mirror image. There is a downtick coming in. Now this pressure, will this lie in the fourth quarter also, or will, there'll be some kind of bottoming out in FY27 or 28? That's what the management will explain us. But as of now, it's not convincing. Return ratios, I'll give a thumbs down. A lot of numbers we spoke about, but apart from numbers also there is institutional shareholding, how things have moved, and promoter conviction is strong here. And look at that, it's maintaining at 62%. Of course, some adjustments, corporate events happen, and that's why they have been buying also in the open market. And see, look at that, 62% stake. That means promoter conviction is very strong in this counter. But are the DIs, FIs, are they strong as well? FIs, we see there is a dip coming in their holding, but DIs are holding the fort. So there are two positive reasons, and I really like that. The DIs and the promoters are betting big on the company. And remember, the stock hasn't moved. There has been a downtick in a lot of stock. That's the reason the next rating I would give you. But overall shareholding, it's a strong thumbs up from my side. Let's look at the street cred, the stock price movement. Kitna paisa banaya ye stock, and concern lies 6 months down 32%. Let's look at the other parameter. Year to date, it's down 27%. Remember, earnings is the biggest factor here, and that's why market is not liking that, and the street cred is all in the negative. But let's see, in 5 years, if you had invested the money, how much you made? You just made 100%. You doubled it, and largely markets also double every 4 to 5 years. It's not very convincing, and if you are taking a risk in a mid cap or a small cap, you deserve higher risk. That's why I've given you a thumbs down when it comes to the street cred. But let's talk about the valuations, and I had mentioned you earlier in the show that the company doesn't have a direct peer. So what we'll do is we'll do the comparable valuations for Poly Medicure to see whether any value lies or not. The peak, the euphoria in the small cap space, that was there in the 2024 end, and this is also one of those accidents, we could say. 80 times 12 months forward P the stock was trading at, but then the commoditization, the numbers, the trade deal issues, that came in as well. Right now, net it's 47 times the 5-year average. That's the benchmark I'm getting it to value this company in this rating. But currently, what's the number? It's just 33 times. Does it make it very cheap? Company specific, yes, but the industry itself seems like a commodity. That's a question I had raised. Maybe that's being factored in here. To play even Stevens, I have given it a neutral rating when it comes to the valuations for Poly Medicure. But the outlook, a lot of questions are being raised, but company is trying. The con call I have heard, it has been, showing some green shoots, but that's what the management is claiming. The ground reality might be a bit different. The export weakness, that's still persisting. The benefits from the recently concluded global FTAs, that might be a game changer for the company. But what are the timelines? What are the numbers? The return ratios, they have been impacted on the acquisition and the fundraise. By when they will normalize, that is where the investor interest starts coming in. And the trade dispute for US medical devices, does it hurt the Indian industry? Or is there any impact on the company? That's very, very much important. And if this clarity comes in, street will like that. And the Chinese competition is still there. And this problem has always been there. Now, if are they flooding in more? Is there some issues coming in? That's something which needs to be, addressed for the company and the industry as well. So, net outlook is still neutral. There are a lot of negative offshoots, but yes, company-specific moves you should always target. You never know, company comes out with a good strategy and they can have a turnaround from here. But let's give you the entire perspective of what are the ratings for Poly Medicure. We have got this counter after a long time. Largely neutral here. The return ratios, they are suppressed because of a lot of corporate actions. Shareholding, institutionals and the promoters are holding up. Street cred, as an investor, if you're already invested in the stock, It's been, a very tough ride. Valuations, they are attractive, but remember the sector has also derated, and we can see that in the numbers. Outlook also, company specific, companies trying a lot, but industry is putting in the pressure, and that pressure is because of that I've given you the lower end of my rating. It's coming in at 3.5 out of 8 for Poly Medicure. But to make it doodh ka doodh and pani ka pani, we'll have the management. Himanshu Baid, he has founded this company Poly Medicure in 1995. Also, he has a leadership positions in Nat Health and FICCI, and that's where we'll ask him all the industry specific gossip. And also, he has made the company the largest exporter of consumable medical devices in India for 11 years, and that's a major feat. Joining in is Himanshu Baid. Good afternoon, Himanshu sir. Of course, looking at the numbers, it was weak. We'll start with the Q3 numbers. There was export weakness. There is an industry pressure coming in. Your con call seems you're fighting it out. Give us the whole picture.
See, I'll tell you, if you look at, Q3 growth numbers, if you look at standalone numbers, we had only 2% growth, and especially exports were down in Europe. But when we look at the consolidated number, because, we did two acquisitions in the last quarter, so those have started kicking in. And mainly this was done to strengthen our European presence. And we know that Europe is going to be a prime market, it was a prime market for us. It will be a prime market for us in future. So I think for us, that was the most important, decision to go direct in the European market. And I think that is helping us now. And gradually, we're going to build up more scale in Europe. And that's how you see the revenue growth, especially Q3 to Q3. If you look at YOY, also the numbers are growing. So we have a 9% growth in 9 months, and we have almost 16% in quarter growth. If you look at consolidated numbers, standalone, of course, are still very tight, very minimal growth, I would say. But I think we are India business is still growing, is doing well. The private business is growing around 22%. Government has a decline of -20, but overall is grown around 18%. And we hope that we'll do probably 22, 23%, or maybe a little higher for India overall in this year. And exports may remain flat. But I think next year onwards, export will come up because a lot of things were held up in Europe because of change in regulation, change in market conditions. US was kind of stalled because of the trade deal and the tariffs we had. So I think now everything is in the past, and I think a lot of new products we have developed. A lot of new products have been certified in different markets, and we have almost close to 100 new products under development, which will be launched over next 3 to 5 years. So I've given you a lot of food for thought, but then I can go on specific questions.
Right. Himanshu, a lot of questions are there, and I've been deeply following your company, but I just need to get a clarity. Medical devices from US, the US medical devices, I was just reading the trade agreement or just the snippet of it. The trade agreement is officially not out. Just two odd pages were there. On medical devices front for US based companies, there seems to be some kind of an exception or some benefits being given which will be coming to India. Is it detrimental or is it negative for the Indian sector? If yes, if there is any quantification of it, what is that clarity? We just want to know that, Himanshu.
So I think let's look at what we are buying from US. So we are buying high technology products from the US market. And I think that those kind of products are not manufactured in the country today. And I think, and with those products come at zero duty, I think we are okay because, they are, first of all, not manufactured in India. If you can lower the cost for those products for patients, I think Indian industry is okay because India industry is still in the, I would say, let's say low to medium technology. We are not still there in high technology. We have very little presence in the high technology segment. Most of the US products come in the high tech segment. And I can talk about like products, specialized catheters, specialized equipments which are coming from the US. So I think that's what is happening today. On the other side, for Indian companies which are selling in the US market, the tariffs were hitting us because India had the highest tariff from Southeast Asia, basically. When we compared with Vietnam or Indonesia or Malaysia or Thailand or even China, we had higher tariffs. So that was impacting the business for low to mid-tech companies. So that is now gone. So we have an inherent advantage now because we had many contracts we had signed with US companies, but nothing was getting finalized because of the tariff situation. But now everything is clear. So we will see more now traction building up for us in the US market. And also, I think it's a big advantage for India today, where the tariffs are just 18%. So I think and we are largest consumable exporter from India for last 11 years. So this will really help companies like us which want to go directly in the US market with what we are doing today as manufacturing.
No, that's a very important point, Himanshu, you made sure because the street was very much confused. The
Yeah.
US medical devices coming to India and might be impacting the industry. So very importantly, Himanshu has stated the clarity which is coming in, and that's why KYC is one of the most important rated shows in TV. But of course, Himanshu, coming back, I would like to ask about the transition which you are talking about, the low tech products. Generally, they are lower margin also. Now you're moving to the high tech product. There are some industries also which you are catering to, a bit technical, but I want to ask you the product profile, if it changes, by when it changes, maybe 2 year, 3 year, what's the timeline? And the margin profile, consolidated or blended, what will that be there? That will also change definitely. So give me both of these points, the answers.
So I'll tell you where Polymed, see Polymed, we operate in the consumable segment, but still we were making close to 25, 26, 27% EBITDA margin, and that has been very consistent. Even if you look at our Q3 numbers or 9 months numbers standalone, we are still doing close to around 26% EBITDA margin, which we had already called out in the beginning of the year because we saw some softness in the European business. And of course, at console level, it drops to around 24%. And this is because of the two companies we acquired, which operated lower EBITDA margin. Now, when you see going forward, in business, our focus has been more or less in Europe and developed countries. We are not selling more in Africa or let's say, other, countries where quality is not. So Polymed has always been focused in markets which are highly developed. And today we have a strong presence in top European countries, in very developed markets, whether it's Australia, New Zealand, or other important developed markets which are there in the world. And of course, we are entering US. Of course, there's been a slow ride, but then the ride will get faster, as things change in next few years. So I think margins will continue to improve. Of course, there was a dip this year because we have invested a lot in people, in developing new technologies. We have built a strong team in India for our new businesses, which were in oncology, in cardiology, critical care. So we have hired, a lot of people. We have seen the commentary also, when we did a quarterly call. So that is helping us to build those products. And in those categories, we have a direct competition with multinational companies. So that's what we're trying to build as a whole product portfolio. We are going in therapeutic areas which are going to be, let's say today, if you look at a hospital, 70% of the patients are either for cardiology, oncology treatments, renal treatments, or orthopedic treatments. So Polymed has got into all these four categories in last few years. And that's how we see the business progressing in next, when we see the TAM global, total addressable market, that is huge in these categories. So slowly we are
Right.
moving up on the value chain in these kind of categories. We'll continue. We have a leadership role in infusion therapy globally, and we'll continue to do that. But when you look at the global presence for Polymed, we are a global company. 70% revenue comes from exports,
Right,
international
Himanshu.
business.
That's an
Yeah.
interesting query I have, and I'm a student of the industry cycles also. This industry cycle, when it starts to pick up, so how do we see? And now you're in the high value zone. I presume it's a 3 to 4 year upcycle which starts in because all the worst is getting factored in for the industry. I'm talking about not your company, just the industry, and you are a spokesperson of that. So your view
Yeah.
on that, when does the upcycle start actually? And if it does, how long will it be there?
So if you see India's exports this year, first 9 months for medical devices have been flat. The country exports I'm talking about. Last year we had just a 4% growth. So yes, Indian medtech was not growing, and even the exports were not growing out of India. Though we have seen thousands of companies started manufacturing medical equipment or devices from the country, but our exports have not been growing in last 9 months. And there were certain, technical issues. There was regulatory challenges, India, global. So all that was getting factored in. But now and then, of course, Europe slowing down, America, tariff issue. Other markets, there was a turmoil, freight challenges were there. So all that is now coming is in the past. Freight rates, which were highest in the beginning of 2025, now they've come down, it's now at a kind of reasonable level. So all that is changing. So our competitiveness in global markets is changing, and it will change. And I think India suddenly now is attracting more companies, more international traction, where people are looking at India as a manufacturing source, manufacturing option. So I think next 3-4 years is pretty good for medtech industry as whole from India. That's what I can tell you right now. That's what I've been hearing from the government. Government has come with a lot of these schemes, whether it's PREP or development assistance for local manufacturing, local raw material manufacturing. There was a PLI scheme. All that has come in. It takes time. Medtech is a long gestation industry. It's not that you will see immediately a return, because every
Right.
country you need to register your product. There's a lot of testing, regulatory landscape which you have to cover. From, let's say, concept to final product, it could take four
Right.
to five years in every category.
Right. Thanks a lot, Himanshu, for that. And you have cleared a lot of doubts. And long-term investors, if they are hearing, maybe some value is emerging as well. It's always a pleasure to talk to you, Himanshu, and best of luck for the future.
Thank you. Thanks a
Well,
lot.
yes, so that's the management coming in for Poly Medicure. And remember, the stock is beaten down. And the very important commentary they have stated is the industry might be there in an upcycle for the next 3 to 4 years. Maybe it's a buy the dip opportunity, but do consult your financial advisors. That's all, folks, for KYC today. Stay tuned to NDTV Profit.